Right. Thank you very much indeed for staying for my talk this afternoon. I appreciate I've got the last slot of the day, so I will certainly try and make it worthwhile. When I was asked to speak at the Master Investor Show, they gave me the title of Stocks to Sparkle for 2014, and I don't ordinarily speak about stocks. Typically, we tend to speak more about markets, and so it's a rare occasion that I was forced into talking about companies, but companies I do enjoy talking about. And I've identified 7 stocks here today. As a stockbroker in a regulated industry, I will caveat, these are not stocks necessarily for getting rich on Monday morning. I will try to frame each of the 7 shares with some sort of expectation of why we buy them. They're not all doublers overnight. Some of them will be plays over a couple of years. Some of them are value plays, some are large, and some are small. But really just to give a sort of guide as to how we look at some stocks. So I've got to get used to the screen behind me. The starting point is really, as stockbrokers, we tend to like to work often towards thematic investing. The starting point here is really to try and sort of pick out some of those themes which we have: durability, longevity, and then once we've got our mind around the theme, is then try and sort of pick out some of the ideas within the companies. And as you can see, I'm starting here very much in the UK, with the house building and the construction industry as something that I think has durability over the course of the next 5 years or so. The starting point within the UK house building sector is that we've actually got quite an acute shortage of housing within the UK. This is not necessarily something that was driven out of the financial crisis. Indeed, for decades, the UK has been underinvesting in the stock of housing and has certainly been running below the sort of trends of housing formations in the UK. Certainly, one aspect that I've heard from builders that come to see us at Killik & Co is that they estimate that the UK is short by around 1 million homes in the UK at this stage. And actually, if you look at where sort of housing formations, population growth, the demands are required, houses are expected to, or new houses, we expect to need between 250 and 300,000 homes per year. We have been running at way below that before the financial crisis. The financial crisis added to the problem, of course, as we took a number of house builders out of the sector, and we were running as low as building just 120,000 homes per year. So where we're at this stage of the cycle is that there is a huge emphasis now on trying to ramp up volumes. It's politically driven. And you will note that we've started to see that number creep from the lows of 120,000 homes per year up to 200,000 homes per year, still short of expectations, but indicative of the sort of volume growth that I think will drive the sector. It's important as investors in shares of the house building sector not to confuse necessarily house prices, where you may well have a negative opinion about house pricing, with why you should buy a house builder. I actually think a house builder is a much better way of playing the housing market because they can bring a product to market at the pricing level which suits the market at that period of time. So if the average house price is going up, and they can build products in that environment. If next year house prices are coming under pressure and they fall by 10%, they can start managing their stock to produce a slightly cheaper product to manage their margins through that process. They're far better equipped at moving houses around in any environment compared to you and I as buyers and sellers of houses. We tend to get sort of stuck with a view that our house is worth this or I wouldn't pay that. And that's why you end up with stagnation in markets. House builders tend to make market share during that period of time. So I think we've got at least 4 to 5 years of excellent volume growth within the industry. And as a result of that, the sector itself is a good place to invest. We will drill down to a couple of innovative ideas within the sector. However, there's one area of caution about volume growth, and that is that house builders can only build as far as they have the product to be able to drive volume growth. And there is a real particular issue at the moment in relation to bricks and other materials that are used in housing. During the financial crisis, many kilns that produce bricks were shut down in the UK. And they were shut down to save £100,000 to £150,000 per year as a typical running cost of a kiln, which was facing low volumes of demand for bricks. To refire up a kiln costs £1 million. And so for somebody to actually take the economic decision to refire up a kiln, they've got to be confident of 5 to 6 years of good demand growth in order to justify spending the £1 million it costs today. And of course, at the moment, they're not necessarily all rushing to open kilns. The net result of that is that brick demand is still outweighing brick supply. There is talk that bricks are turning up to the building site literally warm from coming straight out of the kiln. So where we're looking at house builders, and I quote names like Bellway Homes, companies like that are typically looking at volume growth of around 15 to 20% for 2014 and driving earnings per share ahead, they are all starting to come up, I think, against capacity constraints. Many of the infrastructure bits of their business are running at sort of what I refer to as the red level on the red counter. And in terms of scaling up hugely from here is going to continue to make it a challenging industry for some time. So certainly, as I say, that's one of the caveats for it at the moment. And really the focus for us is how can you scale the businesses in that sector? Now, in terms of the two stocks I've chosen within the sector, the first one is Berkeley Homes. Berkeley Homes is a company that was founded by one of the now most respected entrepreneurs within the house building sector, a chap called Tony Pidgley. And I will start by saying it is the highest rated in terms of price earnings ratio and value to land bank of all of the house builders in the UK market at the moment. But there are a couple of quite special reasons why I think that is relevant and still worth an attractive investment. The first is that Tony Pidgley and his team have had a very long-term track record of calling the investment cycle well. And what they tend to do is that during periods where we all talk about housing being a good investment again, that's the time when they start reducing their capital and paying back cash back to investors. And they have already committed to repaying £1.7 billion of capital that is coming out from their business before 2021. Now, actually, the environment has been so good, particularly in their southeast corridor in London, that the expectation by independent forecasters like JP Morgan is that that cash will come out before 2018, so 3 years ahead of plan. And my thinking around Berkeley Homes is that on top of that money that they are paying out, they will still have significant cash that is coming back to their business of the order of about £2 billion. And this is for investments that were made in the post-Lehman period. They dealt extremely well in land banks across the southeast and in London. Those have gone through planning, they're being built, and they're now being sold out to residential customers. So really the cash wall that's coming into the Berkeley Group over the course of the next 2 or 3 years is for investments that took place just after the Lehman situation, astute buying of land and planning during that period. So Berkeley Homes' market capitalisation today is about £3.2 billion. Returning 1.7 billion by 2018, if my estimate is correct, and still sitting with a couple of £1 billion of cash, that is broadly satisfying the current market capitalisation. So what will they still have left, having sold all of these apartments? Well, my view is they will still be left with the most attractive land bank of property that any house builder has in the UK. Yes, it is southeast focused. Yes, sentiment will flow sometimes negatively towards the southeast based on talk about mansion tax and other taxation that may impact on international buyers that typically take a larger proportion of international buying in the southeast market. But that being said, and sentiment, as I say, does flow around, but I think that by 2018, you'll have your investment largely covered by repaid cash or cash on the balance sheet and the most significant land bank in the UK market. So I think it still remains very attractive. I also ultimately see Tony Pidgley and his team. Tony is aged somewhere around 70. That ultimately, how long does the business remain independent, or will it ever become part of a consolidation play in the London market? It is coming up to an event, I think, within the next 5 years as a company that could well lead to some corporate action, possibly some consolidation in the sector. And they may either be taken over or act as a consolidator within the space. So for me, now there's one other reason I think it's quite an attractive time, and that is because the share price chart, which I show you, has pulled back from £27 a share back down to around £23 in the course of the last month. As you can see, this is a share price chart that dates back to Lehman's back in 2008, and it's not necessarily been a case that house builders have been, the success within the house building sector has not been lost in share prices. These share prices have moved very significantly ahead over that period of time. But the pull back from 27 to £23, I've always said to clients that this is a share that I'd be very happy to buy on the pullbacks, because I know that it's really sentiment against growth stocks, momentum stocks, and you've got to sort of buy these ones on the dip. In terms of if you're buying this stock, you have to judge whether you do that Monday morning or you judge whether there's a little bit more pullback. That's your own call. And do think of Berkeley Homes pretty much as a 3 to 5 year play, particularly to encapsulate those cash returns. Market capitalisation of 3.2 billion. It's not in the FTSE 100 yet, but you've got a number of FTSE 100 companies that are quite sharply reversing in price at the moment. So it puts it in a sort of reasonably good position to possibly be a FTSE 100 contender in the course of the next year. Now, I've picked one other stock out within the house building sector because it addresses it from a quite different angle, and that is a company called Mar City. I mentioned Berkeley Homes' capitalisation is £3.2 billion. This company's market capitalisation is £150 million, so much, much smaller. And this was a company that was only recently brought to the stock market, and I'll quickly flash the share price up because you can see the impact that the reversal of the house building business of Mar City into the company, which was a shell company, has had quite a dramatic impact on the company's shares already. So that's the starting point. But I'll go back to the slide. So why do I like this company? I won't argue about the house building sector anymore, other than to say that this company addresses the much lower end volume market compared to Berkeley Homes, which is typically the higher end. So average prices here would be typically more in the 150 to 250,000, so higher volume. And their core markets are Birmingham, down to the southeast along that sort of M1 corridor that comes down from the Midlands. Now, the quite different angle here is the one that I just want to leave you with. I mentioned the capacity constraints that housing has within the UK, built around materials and labour and supply. This company, I think, will very soon be known as a leader in modular build housing. This is housing that takes place typically more in Europe and America. This is housing that is more manufactured within factories and assembled on site. So it achieves a number of benefits. The first is that it typically takes a house builder somewhere between 3 and 6 months to put up a house. In a factory and assembly, it can be done within 2 weeks. The quality, interestingly, is better with a factory-built house, because often you find that you're building houses during periods of rain, wet, cold. It's enduring quite a lot of weather before you actually get the roof on. And the net result of that is if you can build a large parts of the house in a factory, you're building it in very stable temperature conditions. And the net result of that is they believe that quality is better. And so in terms of actually taking a small company and being able to scale it much bigger in an innovative way, Mars City, I think, are the leaders in this particular space. And they, during the course of 2014, are looking to make a lot more noise about this. So this is something which isn't really on the radar at the moment, but during the course of May, I expect them to be able to say a little bit more at their next update on modular building. Thinking about housing, there is one other area sits behind it, which is an area of interest for us, and that encompasses a business called Breedon. The market capitalisation of Breedon is £450 million, so still a sort of mid to smaller size company. Really key things from Breedon is that their business is where the house builders go to for supplies. They own limestone quarries throughout the UK, typically some in Scotland as well. They own asphalt plants, cement plants. The company was formed by a chap called Peter Tom. Peter Tom is well known as the founder of a business called Aggregate Industries, which was sold to Holcim for $2.3 billion back in 2004. And at the age of 63, Peter Tom quite rightly should be enjoying his retirement over in Guernsey. However, the financial crisis tempted him back out of retirement because, of course, a number of companies he used to compete with ended up going bankrupt, one of which was Breedon. Breedon was a public company. Barclays Bank had a big loan out against Breedon. They called that loan, took Breedon into Barclays ownership, and of course he was able then to come in and help them. Barclays owned these businesses, they didn't know how to run them, and of course they tapped up an industry expert to come in and take it off their hands. Net result was that they put this business back onto the stock market, and that was back in the sort of 2010 period, to the left-hand side of that screen. And really the share price growth that you've seen over the course of the last 4 years has not been about market environment, it's been about what Peter Tom has been able to do with his team to engineer the returns of Breedon back to health over that time. So he would describe the marketplace as not giving him any self-help. This is just about getting back to grassroots and growing this business. Is it all in the price? Well, I think now there are two really interesting things developing. The first is the market is beginning to help him. So for all the reasons we've mentioned about house builders and their growth in their volumes, they're needing more supplies, and of course pricing is starting to go up. So in March, Breedon implemented price rises across the board, along with companies like Tarmac and Lafarge, Holcim, and the industry started to see some price rising coming through. The net result is that if you've got a business with very high fixed cost, you end up with high operational gearing. Profits, I think, are going to move ahead quite smartly. The other aspect to Breedon's business, which I think is interesting, is that Lafarge and Holcim have just announced quite a large merger. This is a $50 billion merger, global enterprises. The UK market, they have many monopoly commission problems, and they are going to have to work very quickly to divest of certain assets within the UK in order to get through some of the merger commission concerns about that merger if it should take place. There is, in my view, only one or two buyers of those assets who could move swiftly with the financing. One is Mittal. He, of Mittal Steel, bought Tarmac's operation and will be looking to consolidate that. And Breedon as well has plenty of appetite for further deals and plenty of support from shareholders. Its market capitalisation is only £450 million, but they have some very powerful shareholders. Invesco, of Neil Woodford fame, he bought 29% of Breedon, He's left, but Invesco, the incumbent manager there, has, I think, committed that he likes the stock and it fits within his remit, so I don't expect him to be a seller. And Neil is obviously opening a new fund, and he's obviously going to start with lots of cash. I'm not in any way suggesting that Neil is a buyer of Breedon shares, but it typically falls into his style of portfolio. He's been very supportive in the past. And if they do have an opportunity to make a bigger transaction, I suspect that they'll have both debt and equity to facilitate that. So that's starting out with the theme. I've covered 3 stocks there. It is a driving theme for the next 4 to 5 years, but playing those ideas. Now, my next stock is a real minnow. This is a company that is capitalised at just £13 million, and therefore I sort of warn that this is a much higher risk investment. And the second thing, I'm just going to give you a glance at the share price, because this hasn't got quite the hallmarks of the previous 3 companies, in that it's obviously been heading in the opposite direction for some time. But this is a £13 million company that has just signed what I think looks like a very interesting deal in conjunction with the sovereign wealth fund of Oman and a company in Dubai that literally built all of the major infrastructure in Dubai. And the idea is that they've now formed this joint venture to build something known as a roaster that is going to sit in Oman, which is going to handle the processing of a metal called antimony. Now, antimony is something which is a very niche market. 200,000 tons a year are produced of antimony, and it's widely used in batteries for cooling and flame retardancy. So literally everything that you look at in terms of clothing, furniture, which requires a sort of chemical coating to reduce flame retardancy, will have antimony in it. So it has very widespread applications. Also, if you hear buzzwords like big data and big processing and computing, they generate a lot of heat. You need antimony in the processing to cool it down. It will be the same for cars, battery-led cars that need cooling down. So it's only a niche market, but a very much in demand market for what it produces. Now, TriStar started out life as owning antimony deposits. It owns a deposit in Turkey, and it owns a much larger deposit in Canada. But what they wanted to do primarily was, when this stuff comes out of the ground, they wanted to take ownership of the processing that turns this antimony into basically a trioxide that is used by the chemicals companies. 90% of the world's antimony all ends up on a ship to China, where China takes around $6,000 per tonne out of the margin for processing. And what they've been able to achieve here is that they're going to move around 10% of world production from China into Oman, where they have no import duties, and they're obviously operating these facilities to a much higher level of environmental sensitivity. This facility, when running on 20,000 tonnes, should produce somewhere between $60 and $100 million of free cash flow per year. And TriStar have effectively engineered this project. They will end up owning 40% of it. And the net result of that is I can see 2016 onwards free cash flow coming back to them of somewhere between $25 and $50 million a year, which is obviously significant in relation to the market capitalisation of the business. Their investment is basically going to be largely through a sort of small slither of equity. The Oman Investment Fund are putting in the debt mezzanine finance, and there are banks as well. So it's going to be quite a highly debt structure. But I obviously, you can tell, see this project as being worth to TriStar many times the current share price of the business. There is one other angle on this, which I think is going to be more interesting going forward, particularly those of you that are interested in the gold market. There is talk at the moment about the merger of the 2 biggest gold manufacturers in the UK, in the world, gold miners in the world, Newmont and Barrick, about a possible merger. And if you look into the text of what some of the issues that they have, refractory gold, they have huge reserves of refractory gold, but refractory gold is incredibly hard and very expensive to treat. But what TriStar has proved up is that their technique of roasting antimony can also work for refractory gold. And they are now talking to some very interesting partners about developing the gold aspect to this business as well. So this is, yes, it has resources in the ground, but this is a company that I do think has a much bigger role to play in the processing of certain metals, which I think is a far more interesting market than necessarily digging stuff out of the ground. Now I'm going to carry with three final stocks. We at Killik & Co are always interested in special situations, and indeed we have a team who run money for what we refer to as special situations, and I tasked them with giving me their three top picks. I will caveat, and it actually applies to all of these, that these are stocks that Killik & Co clients are already invested in. It's the same for the previous four, but I'm hoping that that's why you wanted to hear from me today, rather than ones that we are not putting our money into. But these are stocks that the fund is exposed to, and the first one is a company called Optimal Payments, and they picked out this stock again because they think the buying opportunity is because recently, as technology companies have seen with a lower multiple, a sell-off, that there are some good buying opportunities on the pullback, and they reckon Optimal Payments is a good buy at this level. 600 million market capitalization business. It's a big company, and it was formed by a combination of a business called NetBanks and NetTeller. NetTeller was a business that provides payment systems for those gambling websites across the globe. Now in the UK, it is quite easy for you to be able to process payments directly from your debit card or credit card to gambling websites, but that's not the case in many parts of the world, and what you have to do is form a wallet where they make the payment on your behalf. NetTeller was originally a business that were very big in this particular space. They formed with NetBanks, which was a company that does more general type of online payment systems. Now, there are some big players in online payments, but there are certain transactions that expose you to risk. The travel companies, for example, expose you to risk, because you typically have large payments going out, typically many weeks before you exercise the purchase. And so there is scope within that period for either the travel company to go bankrupt between you and having taken your money, or you deciding to change your plans. And so for many of the very cheap, large processing companies, those are businesses which they couldn't do economically at cheap levels. NetBanks tend to operate on their side. So they have quite sophisticated fraud prevention techniques, which allow them to be able to sort of minimize their risk in that area. So this is a business where recently the shares having come back from 5 to 366 means the multiple has come back to about 19 times earnings. However, they have about 100 million of cash, so about a sixth of the market cap is in cash at the moment. It is generating quite a lot of cash at the same time. And their stated plan is to make further acquisitions. In this business, further acquisitions tend to be quite materially earnings enhancing, because you're looking at a sort of fixed overhead, and things tend to operationally gear above that, so as more revenue is placed onto the platforms. So we think that it will be acquisitions during 2014 which will drive that multiple even lower from here. So we like Optimal Payments. New Britain Palm Oil is purely a value play as a company. It was £9 a share, and it came back to £4 a share. So we think it's good value at this level. Across the world, more and more use of palm oil for food processing as food tastes become more sophisticated means that you've got quite a bit of demand for palm oil. Palm oil prices tend to fluctuate, and for anybody that owns palm oil ranches, then of course you end up being quite exposed to the cycle of pricing. What we think is that that share, as you can see, is quite close to a low, but what it hasn't picked up is that the crude palm oil price is starting to move back up again quite strongly. And we think that there tends to be a little bit of a lag before people wake up to palm oil prices moving up and what it can do for earnings per share for these companies. But to give you some sense of the upgrades that we're already starting to see, on that bottom line there, or the second line up, every $10 shift in the underlying price of palm oil, it leads to about $4 million profit to New Britain Palm Oil. Recently, or last year, earnings per share were forecast to rise from 7.4 cents per share to 47, and I actually know this week further upgrades to 52 were seen. So this is a company where I do think the upgrade cycle is about to take off, and yet the share price still sits as a value play on about 7 times earnings. So, so on our numbers, that looks a good value play to buy at this stage. They did have to endure a partial takeover about a year ago from somebody who bought a bigger stake within the business at $5.50 a share. So they bought a bigger stake at about 40% premium to where we are today. And then the final one from me is a little bit more of a specialist company, but this one is called Flow Group. So I put it in the higher risk category, but it's an 18 million market capitalization business. It is getting a decent following, even though it is reasonably small. It's concept stock, and so at this stage still lacks revenue, but that can change in 2014. It's developed a new style of household boiler known as an MCHP, which combines heat and power. The concept is that actually the heat that it generates can be sold back to the electricity grid, and therefore can significantly reduce the cost of energy to the house. And they've been running trials at the moment just through an online trial facility. They've got 6,000 trials that are being taken, and the commercial launch is anticipated for September 2014. I don't like dates like that because they tend to miss by a month or two and the markets can get disappointed, but so far they're still planning for September 2014. How this will work? Well, the key is that the boiler is cheaper. Typically a new boiler costs around £3,000. This will come in around £1,600. In terms of the number of boilers that are replaced on an annual basis, about 1.6 million boilers are replaced annually, and we're working on a 4% market share, which would equate to around 10 million of EBITDA to Flow Group on those sort of numbers. Typically, clients would sign with Flow Group for 5 years, but the cheaper energy would actually pay for the cost of the boiler during that period of time, and then the benefits will accrue to the customer for thereafter. And that's going to be the business model. So they are going to create, to all intents and purposes, their own utility business. And the company recently raised about £17 million from institutional investors to really take this all the way through from launch. So they have now got the funds to get them to that sort of first stage for the business. So we all know that household energy is a terribly wasteful thing. We all got to try and drive down the cost of energy. That's a theme for us, and we think sort of innovative technology like this is typically going to be sort of have plenty of political and market support for that time. So I think the expectations are modest, and this could quite quickly become a very profitable business. That is a sort of share price. And as you can see, it had a wobble towards 2013. Typically, these companies, when they are requiring new funding, that's the time when share prices tend to come off as institutions come in on the pricing. But of course, since the fundraising, the shares have been moving higher. So it's got quite a bit of support. So on that basis, that completes my 7. I don't know how I did for time. I think I was probably overrun by 5 minutes, but I hope that they've all been sort of useful. There's something in there for everybody. And of course, we'll always be happy to talk to you about each of those recommendations should you want to know more information from Killik. Thank you.